Here are 5 critical points to compare real estate and stocks. I'm going to choose a rental property for real estate and an index fund for stocks. 1. Getting started. You can kickstart your stock portfolio with just $100 by buying an index fund. But with real estate, you're going to need a lot more cash. We're talking down payment, which is usually about 20% plus closing costs. Picture this. You could start investing in stocks with just your weekly coffee budget, but for real estate, you're going to need at least enough to buy a decent car up front. So getting started with stocks is much easier than real estate. For getting started, I'm giving real estate 5 from 10 and stocks 10 from 10. 2. Return on investment. With real estate, you've got 3 types of returns: monthly cash flow from rental income, property value growth, and depreciation. With stocks, you're mainly looking at the value growth and possibly dividends on certain stocks. Imagine owning a rental property. You're pulling in monthly cash flow from the rent, watching your property's value go up, and enjoying some tax breaks through depreciation, mortgage interest payment, and any fixes you do to the property. We call this internal rate of return. A good internal rate of return is about 15%. For stocks, usually, the value of the stock goes higher year after year, and in some cases, you could get dividends every quarter. If you are buying an index fund and holding it for a long period of time, you will make good returns. The historical average is 10%. Both strategies are good here. However, real estate can have a higher return. For ROI, I'm giving real estate 8 from 10 and stocks 7 from 10. 3. Leverage and control. With real estate, you control the asset. You can add a room to the property or improve the rehab and get a higher rent. It is like being the captain of your own ship. Add to the control the leverage you can get in real estate, for example, buying a house with 20% down and taking a loan from the bank for the rest, so you leverage the bank money to own the house. For stocks, you're one of many shareholders and have little say unless you're a major investor. Basically, you have very little control over stocks. It is like being a passenger on a cruise ship. You don't have much leverage with stocks as well. If you want to buy a stock, you have to pay it in full. Most banks will not loan you money to buy stocks. For leverage and control, I'm giving real estate 9 from 10 and stocks 2 from 10. 4. Tax advantages. With real estate, you have many tax benefits, like deductions on mortgage interest and operating expenses. Add to that depreciation, which is the reduction in the value of a property over time due to wear and tear. If you have a rental property with positive monthly cash flow, you can show negative income by adding depreciation and not paying any taxes on that income. With stocks, if you keep the stocks over a year and then sell them, you will pay long-term capital gains tax, which could be less than the ordinary income tax rate. But the tax advantages here are not as good as real estate. For tax advantages, I'm giving real estate 10 from 10 and stocks 5 from 10. 5. Risk. With any investment, there are risks involved. Rental real estate is no exception. You have to account for vacancies. When you don't have a tenant that pays you rent, you still have to pay your mortgage. Sometimes a tenant stops paying the rent, and you have to evict while paying the mortgage out of pocket. These are just some of the risks involved, but if you have enough cash reserve, you should be okay. For stocks, if you buy an individual stock, then the risk is very high, especially if you are buying growth stocks. On the other hand, if you only buy index funds, then there is very little risk because you are buying a collection of top companies and betting that not all of them will go bankrupt. For risk, I'm giving real estate 7 from 10 and stocks 9 from 10. As always, it's not a one-size-fits-all answer. Your financial goals and risk tolerance will help determine what's right for you. If you liked this video, you will like this one next.